Okay. So based on this daily candles chart pattern, I would be inclined to anticipate that the market is going to go and take on these lows. Now, if it's going to do that, what does that mean for the overall market? It's likely suggesting that the upcoming earnings with other companies, like say for example in Tesla, that is likely looking to take a dive to the downside. This is the elevator count I had drawn in advance to anticipate how the movement in Tesla is going to transpire. This is dating back to like January 2023 bottom. So my thinking is that with Tesla, you are macro bull, like you should be thinking of upside movement happening eventually. But going into the earnings, I had a pretty steep drop happening to like at least 160, taking out this lows at about 171 and taking out the low of 182. So in here, this initial decline which you saw from July 2024 high till 5th August, that was the A wave, and this was the B wave till like September high. And I think we're in a C wave, which should take you down till at least 160 on the earnings report. In essence, you should be taking off it from this low to this high and looking to take it at least till 0.79 around there. Because if Tesla is gonna like drop, that will likely add pressure on other names. The other name which should be concerning is Amazon because Tesla is directly linked with the same sector where Amazon is present in. That's the XLY sector. That's a consumer discretionary index. So when you look at the XLY sector, actually I've never opened this chart in a long ass time. All right, so on the 3 week chart pattern in play is this inside 3 week candle. And I think Tesla's earnings is likely gonna make it drop, make it come lower. And once that drop happens, I think it will be ripe to go higher again. From Elliot's standpoint, I would suggest that this looks like a one, that's two, that's a three, and this could be a four, then a five. That's generally how inside weekly patterns play out. So with Tesla going down, XLY should be unfolding its C wave to the downside. And I would want to see some strong movement to the downside after earnings for Tesla to take XLY down. But once it starts basing out on the drop, then I would be looking at option calls to start the fifth wave on XLY, which should take Tesla up as well and Amazon up as well. There are some weird dynamics in the market because Microsoft is clearly doing its own thing and is wanting to attack the inside 2 week candle highs. It's going to do that. I don't think it's going to stop. But the only thing is, while Microsoft does that, Nasdaq will remain somewhat supported. So even though if I'm suggesting that the market is going to go down, it may not go down in what you call like a strong fashion. Like you will see this insane chop happening because what would happen is that when Microsoft is going up, you would be witnessing downside pressure on Nvidia. So they both will like kind of balance each other out while Microsoft catches up with whatever Nvidia has already done, which means that Nasdaq doesn't go anywhere because they both are like the heaviest companies in the index, which is quite apparent right now that Nvidia is down 1.8% and Microsoft is at 1.4%, which technically means that Nasdaq doesn't really see the same kind of a drop which Nvidia is witnessing at the moment, right? But I had noticed with, let's say, QQQ, we are in this rising wedge kind of a pattern. So anticipating that you're gonna do a free fall in the middle of nowhere in this rising wedge, it's kind of suicide. Like, because you could get whipsawed either way. You could either go up and take out this high again, like with this one, and tap the upper trend line, or you can go down, tap the support trend line. Like, either things could happen. So the trading conditions are really horrible to be trading Nasdaq as it is. What I witnessed is much better. Is Dow, because Dow Jones actually had a very significant decline for the entire week already. And that's primarily based on XLI. XLI is the industrial sector. So with the industrial sector, I think this is the overall channel which is being dealt. And while XLI was going down, that put in quite a bit of pressure on Dow. So you can see that this top in Dow, 15th of October, was this top in XLI. Dow went down, XLI went down. This upward pressure in XLI was this upward pressure in Dow, and then this entire drop was this drop in Dow. So my thinking is that if you do want to trade something, I think Dow has much better risk reward ratio because XLI had already suffered like quite a bit of a correction. And what I was witnessing on the 2-day chart, what Dow just did is come and fill this fair value gap. See this high and this low, so this area in between, that is a support zone. But don't get me wrong, this is a support zone which is going to give you a bounce. However, I'm looking at this as being a very, very potentially strong resistance zone, which should ideally hold if we do get a bounce. Like, it should hold as a very strong resistance and put in some kind of a lower high in the market. So say, for example, right now we got an SFP on Dow, and it's giving you a bounce. Like, we took at this high, we closed above, and we're rejecting it and going higher. So I would be thinking that Dow attacks this high, this particular high, which is setting over here. And after attacking that high, my eyes go straight to here at this bearish order block. Now, the downside on Dow is very limited because this 3-day candle has already done too much damage, and we closed this 3-day candle in 6 hours. So we're talking about the entire 3-day candle traversing the previous 3-day candle. So that's like a bearish order block information. And it has already taken out the entire upside candle from last week. So whenever you attack a previous week's low or previous week's high, there is generally profit taking. So if you've been short on Dow, this is where you're going to be booking in profits, and that's causing like a short squeeze to happen. Now, when this short squeeze transpires and you do like a counter trend retracement, you should be taking a flip from this top to this low. And if it comes to 0.79, that's a short overlap. if it can get till there. All right. I do think it's going to get till there because this is the proper market structure break where if I were to mark like higher lows and higher highs starting from down here. So this was the high, this was a low, this was a lower high, this was a lower low. And the moment you went above this lower high, that's the shift in market structure, and the market is turning bullish. So that's a higher high. This was a higher low, then a higher high, higher low, higher high, right? So when you took out this low, which is the previous higher low, you're actually making a lower low. Now what I'm anticipating is that when the bounce happens, I would want it to make like a lower high in comparison to this high because the market structure is broken at the moment. And once this lower high gets printed and you see like the next leg down happen, that's where I think Nasdaq could suffer a lot. I mean, it's already suffering, but see, this is the difference that this 3-day candle is pretty strong on Nasdaq, whereas this 3-day candle, oh my god, hold on. This 3-day candle is much stronger than what Nasdaq is already showing is. So the movement in Dow has already taken place, which hasn't really taken place in Nasdaq, and it's just starting to do the same movement which Dow is supposed to has already like showed us the way that it wanted to do this kind of a drop. So my thinking is that there will be like a rotation happening where Dow is going to do like a counter trend bounce and Nasdaq is going to go down because Nasdaq was actually going up while Dow was going down. Okay, so that's kind of my thinking. Now there is another thing you need to be aware of is the cross market correlation, which is very superior, and it cannot be ignored. So one thing you need to be aware of is that Nikkei is the driver of the entire risk appetite globally, where Japan stock index has a monopoly on how things are going to be unfolding, whether it's in Germany, whether it's in India, whether it's in Australia, or in any country in Europe, even in US, because Japan's central bank has the lowest interest rates. Okay, every other central bank has interest rates sitting at about 5%, and they're just starting cutting, like they haven't finished the cutting cycle. However, because the interest rates in Japan are sitting at zero, every country goes to Japan to borrow money, and they use that 0% interest rate money to basically go and invest in the respective country's stock indices. All right. So while we understand that this kind of a trade has been happening, which was literally driving the price up for Nikkei, because it's like a sympathy play, right? That since January 2023 to like June 2024, Nikkei was going higher because it's 0% interest rates. That it's risk appetite. Like you have to be risk aware whenever interest rates are sitting at zero. However, that particular cat went out of the bag when Japan's central bank came out and they said that they wanted to hike interest rates. They don't want to keep it back at zero as they had in the past year and a half. So the moment they announced that they're going to be doing that, Nikkei just went bonkers. Like it wasn't like a normal kind of a market. This is what happened when the Japanese central bank came out and they announced that they're going to be hiking interest rates. Like Nikkei went on a tear and it went down by at least 30% within just like a month. That's when the Japan yen carry trade, is what most people talk about, started collapsing. So my thinking is that, well, ever since that collapse happened, I was mapping out the elevator count for the entire thing, and it was very, very simple to understand that this was a one, this was a two, that's a three, that's a four, and that's a five. That it was a very proper bearish impulse of 1, 2, 3, 4, 5 to the downside. All right. So once the bottom get printed over here, and the market started bouncing, as you can see the bounce happening, most might think that this is a very, very supreme bottom, and you're not going to be revisiting it because the Japan central bank panic, and they're like, okay, but we're not going to hike anymore for now, and we're just going to keep it where it is, right? But because they open that can of worms, which caused such a strong reaction to the downside. Now, every investor is wary to go back to Japanese central bank to borrow money and use that 0% interest rate and go and invest in other stock indices. So, obviously, that had like a psychological effect on how you should be doing business with Japan. Now, that made me think that ever since this bearish impulse got printed, I had to consider this entire move as an A wave, this decline as a B wave, and then a C wave to be unfolding eventually up top. So that was a B wave bottom. Now the C wave also unfolds in the form of a 1, 2, 3, 4, 5 to the upside. Where this was a 1, that's a 2. I think this entire thing is a 3. There should be a 4. There should be a 5. Now I know this is a 5 because of how sideways this price action is going. The initial sharp drop, which makes you panic, is likely the wave 4. And then you go on a sideways, sideways, sideways tangential, where the market is basically printing inside weekly candles, or it's better seen on the 3-day chart, where you initially had inside 3-day candle, and then another inside 3-day candle, and then you poked it right above. That was the wave 5 for you, which is being printed, the sub wave 5 of the wave C. And this is where we're sitting at the moment, rejecting that high, and we're breaking down, breaking market structure, going to the wave 4 low. Suggesting that, the moment you break the wave 4 low, it's all over. I think, in my opinion, then I'm correct about the fact that this being a ABC correction, this being a 1, 2, 3, 4, 5 down. So if you break the wave 4 low and you're saying that the ABC correction is over, then what does that mean? It basically means that from here, this is a A, this entire thing was a B, and this was a C. We're going to start going down. For Japan, that is. Which will look like this. Okay. A wave being the 1, 2, 3, 4, 5 down, ABC as a B wave, and C wave being the another 1, 2, 3, 4, 5 down, just like this one. Now you may wonder why exactly am I telling you all this? Like, what is the whole point of discussing Japan? Because we don't even trade it. The reason I'm discussing all this is because Japan is basically a proxy for NASDAQ. And since I mentioned the whole shenanigans of US investors borrowing money from Japan at 0% interest rates, they bring that money to US and they basically pump it in NVIDIA. And NVIDIA is linked to NASDAQ. So if NVIDIA is going to go down, that means NASDAQ is going to go down. That means every other company in the US stock market is going to go down. And I'll show you what the implications are. Like, let's just mark the major swing highs and swing lows so that you would understand what exactly I'm talking about. So it's quite easy to interpret that these are the major highs and major lows. I'll go into the details over here in a moment. But let's compare with what NASDAQ looks like. Now, do you see the resemblance? This high is this high. This low is this low. This high is this high. This low is this low. This particular high, which I put in blue, is this high over here. Okay. Now, we already know that Nikkei is going for this low because of the inside 3-day candle failure and the way it's playing out. All right. That basically means this particular low is this low over here in NASDAQ, 18,315. This low, 27th of September, is this low. Okay. Nikkei is already sitting close to it. Like it broke these higher lows and it's accelerating to this particular low, which basically suggesting that NASDAQ should be accelerating for this low, pending some kind of a catalyst. It could be Tesla earnings, could be FOMC, could be big tech earnings that are going to like happen next week. But that is the flow. That is where the market wants to go because Nikkei is ordering everybody in the global equity space that this is what you should be doing. What's concerning to me at the moment, this is where you gotta be understanding basic price action concepts. Nikkei already told us that, the drop which is happening here is a very, very strong drop. It's not something you mess around with. Okay? But, and this is a big but, NASDAQ hasn't seen the follow through yet. Why? I actually don't know why, but I just can see that the follow through hasn't happened in NASDAQ to the downside just yet. That this top which was printed and this bottom see, it was tracking Nikkei almost to the tick, where you can see that this low was basically this low over here, and then this bounce happened, which was this bounce. Nikkei went lower high, lower high, lower high, and it just like collapsed. Whereas Nasdaq has just been like choppy and range bound, and it's not exactly breaking down. It's beginning to break down now, where you can see that the higher lows are being taken out, and it's trying to go down, which means that it will be following suit very soon to catch up with whatever Nikkei has already shown us that it's going to do on the 4-hour chart, that it wants to go for this low, which is basically this low over here. So that's where NASDAQ actually wants to go. Like, this is the longer play. Could be tomorrow, could be after earnings of Tesla this evening. And that is where I am concerned that most participants are not ready for this kind of a drop because they're being misled into thinking that all these pumps, which get faded out, that things are fine. Like, it's just consolidation that it's going to go higher and whatnot. But what they're forgetting is that it's literally printing a lower high. Like, it confirmed the lower high right now while we have been on the stream. Where this was a stop run, which happened yesterday evening. And that stop run led to a market structure break by taking it the last higher low in the market, which it did so just 15 minutes ago. Now, because of that, you have to be cognizant of the fact that when I was talking about the triangle part, I wasn't quite wrong about the triangle. It's just that it's a failure happening for the triangle, where you can take this as a triangle, but you did a fake out and you took out the highs, then you rejected it and you're going on the bottom end of the triangle. Now, whenever you see a fake out happening in the triangle like that, and it's going down so sharply the way it is at the moment, think inside daily candles or inside 2-day candle. So in this case, if you go on the inside 2-day candle chart, you can see that the market has printed that's an inside 2-day candle. And this spike, which we saw yesterday, that caused a failure, and that has caused a massive shift in market structure. Now, because of this chart pattern, I am inclined to think that this is going to like expand to the downside very quickly because it's triggering sell triggers on the lower time frames, and we have some catalysts coming in the coming week, next week as well, and also tomorrow, like at least like after the market closes tonight. So if you do get any kind of a scam bounce in the market, I think you need to be considering the fact that you need to go short on Nasdaq and attack this low and then eventually this low. So if you want, you could try puts for next week's expiration. On, I think they should be able to print. They should be able to print sizably. Well, QQQ, maybe not QQQ itself. There are weaker companies you could try puts on. Now I am aware that QQQ is driven by SMH, which is suggesting the fact that SMH is going to go down, and it hasn't quite gone down yet. But there are companies which are driven by SMH, like AMD, and AMD has already given you a sizable decline, which leads me to my previous analysis I did on AMD, where I had interpreted that AMD will be coming to fill this gap over here on the daily chart, and it exactly did that, and it's been rejecting. So I'm thinking that AMD is going to be going for this low and this low over here. But is it going to like do it in the coming weeks? Probably not. But it's a play you can take going into elections. Let's just put it that way. That it's yeah. Let me go into that. I'm trying to think about the technical setups which are best to follow what's happening with Nasdaq. So with Costco, I actually don't want to short Costco, even though I can see the chart pattern, which is suggesting is that if it take at the high, rejects it, it's going to go lower. If Nasdaq's going to go lower, you could try a short on Meta, but the option contracts are not going to be cheap for that. Meta has earnings on October 30th. So if you do buy option contracts on Meta, they're going to be pretty expensive. Yeah, so Costco is going to make all-time high. I am not concerned about that. But once you make that high, I don't think you should be sitting in Costco while Nasdaq's going to see like a correction happening to the downside. Right now, the pattern is this inside 2 week candle. Just like when I was talking about Microsoft going higher and taking it this high, that was basically Costco doing the same thing, where it's going to go and take out that high. But once you attack those highs, then all bets are off. Like it could do free fall and catch up with Nasdaq if it's down enough. If Nasdaq can go down, Apple can be a good short. I think Apple is going to go down along with it because they both are kind of tied in similar fashion. Yeah, November, I wouldn't say November 15th, but just to like November 7th. November 15th is way too much of November. No, given that time frame, November is historically one of the strongest months of the year. So you don't want to be holding that short way too deep into November. I'm just gonna hold that short till like elections are done with. So November 5th is when the elections happen. If you want, you could hold it to like November 8th till the max. If you want, you can even short Nvidia. Nvidia may not be a bad idea because in Nvidia the pattern is this inside quarterly candle. You just took out the highs and you're rejecting it right now. And we know that Nvidia kind of controls SMH, so SMH is going to go down to bring Nasdaq down, which will mean that Nvidia goes down. So that's a speculative play, but I think the risk reward ratio is pretty good to short Nvidia. You can short Tesla. I mean, why not? Okay. You could even short AVGO. It's also sitting at all-time highs right now. And if the market is going to go down, which Nasdaq is going to suggest that it's going to do, it's the same setup as Nvidia. You can decide which option chain gives you better bang for the buck. Because AVGO basically follows Nasdaq itself, because SMH follows Nasdaq. So if Nasdaq's going to go down, that would mean AVGO goes down too. But I suppose you get the idea on why I'm trying to entertain shorts at the moment. Like there's a clear indication being provided by what Nikkei is doing. that how far down it's sitting at. And because of that, I want to have some kind of a short bias in Nasdaq. And we also need to be aware that elections are not that far away. Like you're literally just less than 2 weeks away from elections. And I just don't think that VIX is going to be setting at 18 going into elections. It will likely start spiking up and go to like 24 or maybe even 28. So you will be seeing some downside price action happening in SPX and Nasdaq. And SPX is controlled by Nasdaq, so Nvidia gotta go. Like you have to sacrifice Nvidia and take it down. This is a complete mess. Like when you look at the hourly chart, it's just not a trending market. What it makes me feel like Nasdaq is doing, there's a very specific price action I've seen in the past, which resembles something like this. See when this top was printed, and then you made this bottom. Now this sideways price action was very clean. Like it did not take a lot of time. Basically, it did this bounce, made a high, did a pullback, next day went up, did a stop turn, rejected it, and then you see this sideways chop. Like basically when this bottom was printed and this bounce happened, I'm gonna take it over here. Okay. So first thing is to realize that you have this initial drop, which was a proper 1, 2, 3, 4, 5 down. This was the A wave, this was the B wave, this was the C wave. And then you took out the C wave's low, which was signaling a market structure shift. Now, after taking out the low, the market didn't just go down in a straight line. What it did was it did this sideways chop, where it was making this ABC correction. So you see how it came up, targeted the 0.618 Fib, and then it went down. Now, what I'm witnessing in our situation at the moment, let me cover this. From this top, I'm quite aware that this is a bearish impulse in the form of a 1, 2, 3, 4, 5 down like that, which means that this high, where the fair value gap gets filled, that needs to hold. Like price should not be going above that high, which is exactly what's been happening. Like it's been holding this level for God knows how long. This was printed on 15th of October, and we're sitting on like 22nd of October at the moment. It's been like 7 days, give or take, and it's been just going sideways, sideways, sideways to just fill this particular gap. And now the way the market is developing, it's suggesting to me that this was a wave up. This was a B wave down, and this was a C wave up. As in, like you just did the stop run, and then you went lower and took out the higher low, confirming that this ABC is finished. and you should be like expanding to the downside because of that. Okay, so this is a messy market to look at, but it's giving signals on price action structure standpoint that this should be going further down. Now, it's going to go down today? Maybe not. Maybe tomorrow after Tesla opens on the earnings and it drags the entire market down. But now the way things are playing out, like since you take out this last higher low, the market should not be going above this high now. This is like a confirmed lower high in the market. So it may go sideways in between this range, between 2236 and 2477, but it should not go above that high now. If it went above that high, this is not a trending market. Like I don't know what to do. It's kind of fucked then. Like then I would think that it's gonna go and make a new all-time high, and then in that case I have to like rethink the entire strategy because there would be a significant discrepancy in comparison to what's happening with Nikkei, what's happening with every other major asset class. So I'm more so in the camp that Nasdaq basically goes down, and it has to catch up with Nikkei, which is what I'm thinking it's gonna do. Now Dow is suggesting that the counter-trend bounce is starting, which means that Dow should be going up too to catch up with DAX. Now in this case, DAX is a proper 1, 2, 3, 4, 5 like this. Yeah, that's a very good 1, 2, 3, 4, 5 like this. So if it's doing a counter trend bounce, you basically don't want it to. That's the max. DAX should go higher, and once it tags that level, I think you're fine to take it down. Like it should not be going above that because this is a very proper stop run, which the market did. And if you go above that level, you will be breaking market structure to the bullish side, and I don't want to see that happen at all. It's fine to like bounce till there, reject it, and then go back down lower. So while this bounce is happening, maybe Nasdaq can do a bounce too. But this is a very heavy market. The way SPX is behaving, the way Nasdaq is behaving. So right now with SPX, honestly, this is a piece of shit. All right. So you could probably see the bearish market structure happening where it's making like lower highs and lower lows. The only issue is that it's not going down to break the market structure, which is the previous higher low in the market. This was the main higher low, which caused a spike up and take out that high. So even if it's making these lower highs and lower lows, it's just been a consolidation. It's not trending. Like when I look at this chart, nothing quite suggests that it wants to break down. But I do understand the idea that it has this inside daily candle, which you took out the highs on, and now it's wanting to gravitate towards these lows. But it's just doing it in a very slow, turtle-like fashion, which is making it incredibly annoying to trade the US indices. I mean, when you look at gold and silver, they're moving more than US indices are moving. I'm like, just look at silver. It was up like 4% yesterday. It's down 3.7% today. That's giving me more volatility to trade than to trade like US indices. So it's kind of like a fool's errand, I would say, to try to trade US indices at the moment. But I had to cover this idea to be aware of what's happening with this chop and how the cross market correlation is suggesting that Nasdaq should be beginning to start its decline to the downside, but it needs like a catalyst. It's just not doing it right now because it needs a catalyst. I just don't know what the catalyst is going to be. It could be Tesla's earnings, could be FOMC, could be the big tech earnings and Apple, Microsoft, Amazon next week. So until then, just be careful. Try not to get stuck with the option calls because this is it's easy to think that just because the market is going sideways, you're gonna break out. Which I was like on the bandwagon for, like, you should be seeing like a breakout, because the market structure was intact. It was making higher lows. It was making a triangle. It had to see like a breakout, which it did eventually, but then it like gave it all back. And now you're breaking market structure to the downside. So now I'm thinking, maybe it's finally beginning to catch up with whatever Nikkei has been doing, except it's just not for now. It's stuck in that range. It's not expanding. So yeah, like just wait for a catalyst to come, and then we'll have like proper direction in the market. Hmm. Gold had a very sizable correction today. Good. Well, look at that. That is some drop. Even silver. The mighty silver. It's the 10-year yield. It's so much for the Fed announcing the rate cut cycle, except the yields have been like going higher and higher, which means that the market is calling bluff on the Fed. The market is saying, we don't believe you that the rates are going to be lower. You're not going to bring rates lower because you're igniting inflation and you're going to like bring the rates back higher again. So that's where the market is kind of giving like a big FU finger to the Fed. This 3-month candle on 10-year yields is amazing. I think the rates are going to be sitting at about 5% again. And the Fed may be forced to pause the rate cut cycle, possibly. That's kind of what the bond market is telling at the moment, that the Fed made a mistake and they're probably not going to be cutting aggressively, or maybe just put it on a pause. Which has led to a massive rally in Dixie. And Dixie's like, fuck you guys. On a relative basis, dollar index has given you much better return than trying to be long on Nasdaq or on the S&P 500, which is quite absurd. That this is a currency. The currency cannot give you more return than the index itself. Like dollar index is up like 4%. Let's see. Oh, what a look at that! I'm kind of right. Nasdaq has been up 4% too from this bottom. Whereas Getting 4% on dollar index is far more beneficial than getting 4% on Nasdaq. You have like access to like at least 500 times leverage on trying to position in currency markets. Whereas with Nasdaq, you don't even get like more than 10 times leverage. And gold is having a senior moment. That is quite amazing on how much movement it covered today, which may bring in further volatility in the market. I mean, imagine trying to trade in this market. Holy shit, this is annoying. Amazon literally hasn't gone anywhere for the past 7 days. It's just sitting there. Like there's a up candle, there's a gap down, which basically replaces it as a gap down. It retraces it as a gap down. So I don't know if the market wants to be trending at the moment. It's just very weird. Hmm. And this was one of the good calls I made on Netflix, where I was quite certain that it's going to do a gap up. Now, this is a trick I learned very long time ago with earnings. Generally speaking, when it's a week where earnings is going to happen with the market. So let's say Netflix is going to do its earnings this week, right? And you're looking at the daily chart. Going into the earnings day, just watch what the market is doing. Is it going up? Is it going down? Like, do we see any specific movement in a directional move? In this case, Netflix basically went down, right? Like it was just going down straight, not even giving you any retracement. There's no candle, nothing. Just Monday down, Tuesday down, Wednesday down, Thursday down. So going into the earnings day, it has a very, very huge potential for a short squeeze. Because when you were looking at the daily candles and you go on the weekly candle, the daily candle had gone far down enough into like this week's low and even this week's low. So if you were to anticipate that the market is going to be dropping and doing like a negative reaction to the earnings, that would really skew the way the weekly candle is going to look. Okay, I'm going to show you one more time on how that looks when you're going to the earnings chart. So this is how the weekly candle opened. Okay, you have one daily down day, second daily down day, third daily down day, fourth daily down day. So going to the earnings move, like when the earnings announcement is going to be made, if you're anticipating it's going to be bearish, then you think the weekly candle is going to be further down over here. I have never seen Netflix post such a bearish weekly candle, unless like something really bad happened, which is back here, and the earnings actually like fell through the roof. But nothing on the higher time frame chart was suggesting that it should be going down. Like you're sitting above the weekly bullish or sorry, the this is a proper weekly SR level. And we had a proper bullish on a block formed on top of it, which is the monthly chart. This is a monthly SR level. So if you have a monthly bullish on a block, why would I be suggesting that the market's going to drop on earnings, which would basically mean that you're predicting that the monthly bullish on a block is going to break as support? I don't want to be betting on that actually. Instead, if it's coming down and it's in monthly support and it's going into daily support as well, going into earnings, chances are earnings is going to squeeze and this drop is going to look like it was just testing support and you had a massive reaction from there. Okay, so this is kind of how you time the technicals and what's going to be happening with earnings. Same thing I did with NVIDIA back in the days when it was like expanding horrendously. Like I've seen this thing happen again and again. So you see this earnings call which happened on NVIDIA. If you go back and you look at this weekly candle itself, so the earnings was going to happen on this weekly candle. Notice what happened when this week's candle opened. You had the first down day, second down day, earnings happen, and like all of a sudden, boom, up. So if you're going down into the earnings day, like down, first day, second day, third day, the chances are it's going to do the opposite and go on the other way end because most people are like positioned short. Like the sentiment has been shifted because of these down candles, and they're not anticipating that something amazing is going to happen out of it, which causes even more of a short squeeze because most people have been like positioned short, and if the earning surprises or they do like some kind of an announcement, that is likely going to cause even further rally and short covering to happen, which would fuel up the prices to go even further up. And that generally causes like a bottom to be printed in the market, and you have like a new trend starting from there. Okay, so that's kind of like my trick on what I figured. If you have to play earnings in a certain way, that is kind of how you do it. That's what the market is. Try to anticipate who the market is trying to trap going to earnings, and do the opposite when the earnings is supposed to be released. So let's say if the market is just going up, going to earnings, chances are it's not going to go up after earnings is done, and you will be like getting dumped on after earnings is done. Oof, Tesla. If the market goes down, Adobe can be a good short too, but I think I already mentioned it last week if you wanted to do it. But it should be like accelerating towards like 463. it's likely gonna fill this gap. But you can just take that put on Adobe for like 2 weeks out, going into November elections. That's an easy short to do. Uh, it's a naughty market. Just not going anywhere. Look at that. I had this longer term trendline resistance on gold. We tapped that this morning, and you're on your way down. So I think it's likely going to come down to test the previous high of the week around there. That is where you can see a bounce happen. Until then, I think it's a market which should go down. It's honestly much better to trade gold or silver than try to trade US indices. That they're very messy. At least when I look at Nasdaq, it's pretty messy. Oof, Goldie. Damn, almost. Monday, Tuesday, Wednesday. It's a bearish auto block of gold. Okay, I think that's pretty much it in terms of what I wanted to cover. I'm just gonna wait for Nasdaq to make a move. Like there's nothing better I can do in my life. It's quite annoying to sit on its hands and do nothing. But I'll post a recording for anybody who missed it. I will catch you later. Enjoy Tesla earnings day. Bye.